Hello and welcome to Express videos relevant for ACCA paper F7. Remember, you can download our Express notes, which are the basis for these recordings, on our website at www.theexpgroup.com. In this video, we will cover chapter 3, which actually deals with substance over form and with IAS 18 revenue recognition, which it used to be called. So, substance over form. Both the framework document, the conceptual framework, and also IAS 1 states that the information that we actually include in the financial statement should be reliable and relevant to the users of the financial statements. And by that we actually mean that it should reflect the substance, the commercial substance of the transaction, not the legal form of the transaction. That's why, for instance, as we have mentioned before, finance leases, the assets actually held under the finance lease will be reflected as our non-current assets, although we don't own them. But in accordance with the definition of the framework of an asset, remember, in order to reflect an asset in the statement of financial position, basically you need two things. You need control and you need future economic benefits. And both criteria is actually met. In the case of a finance lease, I do control the asset, is on my premises, and I use it. Let's assume it's a car, and it brings me future economic benefits. Okay, then there is no problem. So it meets the definition, and I can definitely reliably measure it because the amount of money which I basically have to pay for it is included in the finance lease. The idea in the exam is that you should be able to spot the economic transaction which is basically given to you out of, types like inventory sold on a sale and return basis, otherwise known as consignment inventory, or debt factoring, or loans which are basically secured on the assets. Something like, I don't know, bill and hold arrangements, you name it. In order to get the right answer in the exam, the following things you should remember. Basically, what assets is the scenario covering, okay? It can cover inventory, it can cover trade receivables, it can cover work in progress. Read the scenario and decide what type of asset are we dealing with. The second thing that you should ask yourself is what are the risks and rewards of holding the assets. Okay, so if you're talking about inventory, it definitely should be slow movement, obsolete. If you're talking about, I don't know, trade receivables, it should be actually not ever cashing the receivable, meaning no future economic benefits, or slow payment, no payment at all, coming from our customers. And once we decide what is the asset that we are talking about, what are the risks and rewards associated with the asset, okay, then we have to decide which party of the transaction is actually more exposed to the risk and rewards of that particular asset. And once you decide this, that party of the transaction, that entity, that company should reflect the asset in their statement of financial position at the year end. So, let's take an example together. Let's assume we are talking, for instance, about a bookstore. We have a bookstore which is actually receiving goods from publishers. The bookstore, actually, as the contract is signed with the publisher, the bookstore will actually buy the books, when sold to the customers, months has passed from delivery, the publisher. Okay? So the contract is written this. We are a bookstore. We sign contracts with 3 or 4 different publishers. They send the book to us, but actually we buy the book either when we sell them to the customer or after 12 months I have a right to return it back to the publisher. This is the scenario in here. The bookstore actually is recording the books received as inventory at the date of delivery. So whenever a new shipment is coming into our store, we actually book it as our inventory. And let's assume at the year end, we actually have counted the inventory and we have $5,000 worth of inventory in our store. The question is this accounting treatment, meaning showing the books as the inventory of the bookstore, a proper accounting treatment in accordance with IFRS or not? So that's a classical example of substance over form. What we need to decide in here are the 3 things that I've been talking about. What is the asset? And in here it's fairly straightforward. The question says, or the scenario says, we are dealing with inventory, or we are pretending to deal with the inventory. Okay? We receive it from the publishers, we show it as inventory. Second is, what are the risks and rewards associated with inventory? So make a list of any risk and rewards that come up and write it actually down in your exam. So with inventory, the risks are, okay, it can be stolen. The goods might be stolen. And if the goods are stolen, who will actually have this risk? Who will pay for it? It's the bookstore. Yeah? Because according to the contract, a book which I receive from a publisher, if it gets stolen, I cannot sell it to a customer to recover it, and therefore I cannot send it back to the publisher. Therefore, the risk is fully covered, or must be fully covered, by bookstore. Another risk may be, I don't know, physical damage. Let's say our shop is flooded, and therefore in our case, again, since I am not able to return it back to the publisher, I will actually, as a bookstore, incur this risk. What about slow-moving inventories? Because if I'm actually taking the books from the publishers, it sits for a year in my store and it doesn't get sold, I actually have the right to send it back to the publisher. So therefore, the publishers will this time have this risk. What about the risk of actually the goods, the book, being obsolete, meaning nobody wants to read it anymore? In this case, again, after 12 months has passed, I can send it back to the publishers, so therefore they do have actually this risk according to the contract. That's the economical transaction. Now, who has the ability, for instance, to sell it at a profit? Is it the bookstore or the publishers? So since the bookstore has the book, They will decide on a selling price, and therefore this is basically enjoyed by the bookstore. So if you sit back and look at this list, you will basically see that although most of the risks, stolen, physical damage, ability to sell at a profit, are actually borne by the bookstore, in effect, the biggest risks are the item to be slow moving or obsolete. These are the biggest risks. And these risks are actually borne by the publisher. So with an inventory, the problem with inventory is that you do not recover the cost. But the bookstore doesn't pay for the goods when it actually receives the shipments from the publisher. They will pay the books to the publishers either when they sell it to the final customer or when they actually return it back to the publishers. So since the biggest risks are slow moving and obsolete, the publisher will have to actually show the inventory in the statement of financial position. So inventory should be actually sitting in the statement of financial position of publishers at the year end. They actually did not make any sale. They just moved the inventory from their warehouse to the bookstore, and according to the contract, this inventory will stay there for up to 12 months, and if not sold, it will be returned back to the publisher. So from this point of view, the publisher did not make a sale until either it's getting sold by the bookstore to a final customer or 12 months has passed. So the current accounting policy is where we started. Actually, the bookstore having the inventory in their statement of financial position at the year end is wrong. They should recognize the inventory, and actually the publishers in turn will have to have the inventory based on their respective value at the year end in the statement of financial position. If we look back to the notes, this is pretty much one type of transaction where basically we have to deal with inventory, which is basically sold on sale and return basis. We have transactions which are actually covering factoring. What factoring is, we actually sell our trade receivables to a factoring company, and depending on the type or the nature of the contract, again, we have to decide whether or not we have actually made the sale or not to the factoring company. So there are mainly two types of transactions in here of factoring. One would be with recourse, and the other is without recourse. With recourse means I actually sign an agreement and I transfer the year-end values or whatever, the month-end values of the trade receivables to the factoring company. The factoring company will try to collect, and let's say 6 months down the road, everything that they did not collect will send back to me. With recourse, the contract will stipulate, okay, we just signed a sale agreement, I transferred you the balance in return of a cash payment of my trade receivable or certain trade receivables at my year end, and you as a factoring company will try to collect it, but you do not have the right to actually send back to me any account balances that you did not collect it. So the substance of those transactions, with or without recourse, are totally different. So in the contract with recourse, trade receivables are actually, and the risk associated with it, which is slow payment or no payment at all, still lies with the so-called selling company. In a transaction where basically the trade receivables are transferred based on a factoring contract without recourse, then the company, the financing company, the bank, for instance, which is buying the trade receivable, bears the risk of the customer actually paying later or not paying at all. And in that case, the bank should actually have the trade receivables in their statement of financial position. So again, it comes back to three questions. What are the assets? What are the risks and rewards associated with holding the asset? And which is the party who actually bears most of these risks? Okay? So be aware, it may be inventory in your exam, it may be trade receivables, and do decide which are then the risk and rewards and which party is having it. The party that is having most of the risk and rewards should report the asset in the statement of financial position at the year end. Revenue. IAS revenue is a fairly old standard which is up for review. It actually deals with, I think, 5 types of transaction. Okay, what is revenue, or when should I recognize basically revenue? From a transaction which involves sales of goods, from actually providing services to my customers, and from recognition for interest, royalties, and dividends as 3 other types of revenues that can be recognized within the statement of financial position and therefore income statement. In terms of a sale of good, IAS 18 says the following. Revenue from sales is actually recognized when the risk and rewards which are basically associated with ownership are transferred from the seller to the buyer. It does not necessarily mean that the legal title should pass at the same time. So all the risk and rewards should be actually transferred to the buyer. The company should not have managerial control over the goods sold. The amount of revenue associated cost of the transaction should be measured reliably. In other words said, I should know the selling price and I should know the associated costs of the goods sold. And one important element is that it should be probable that future economic benefits deriving from this transaction will flow to the enterprise. Meaning if I sold on credit, I should cash the amount of money coming from this transaction. Otherwise, there is no sale. It's just a loss of inventory. With respect of services, basically, the revenue should be recognized by stage of completion. I would call it, in a simple word, stage of completion. And all the other criteria that I talk about when we mention sale of goods should still be there. So I should recognize revenue by reference to a stage of completion, but all the other like selling price, cost of the transaction which can be measured reliably, and I should be able to go enjoy future economic benefits. In other words, the customer should pay me, or the consideration should be receivable, should be actually be received, should still be there. What do I mean by stage of completion? So for instance, let's assume you are an airline and actually you are selling two-way ticket to fly, I don't know, from Bucharest to Paris. The first flight will take place on 29th of December and the return flight will actually take place on the 5th of January. Okay, and your year end is 31st of December. And the plane ticket is not refundable and you pay for it $500. And the plane ticket was actually paid on the 15th of December. The question is, can I book at the moment that I receive the $500, which is on the 15th of December, can I recognize the $500 as revenue? And the question is no. I'm just providing a service. I have to fly you as my customers from Bucharest to Paris on certain dates. And revenue coming out of this service should be recognized, the standard says, by stage of completion. Meaning, on 29th of December, my liability is to have a plane and crew ready for you on the airport to actually fly you from Bucharest to Paris. So, in other words said, half of the $500, meaning $250 at the year end, it will be revenue, and the other $250 will actually be deferred income, which is a liability, because at the year end, I still have to have on the 5th of January another plane ready and waiting for you in Paris to actually fly you back to Bucharest. Okay? So at the moment, even though the plane ticket is not refundable, I don't have a right to actually recognize a revenue in full. I will recognize it by reference to stage of completion. By the year end, by 31st of December, half of the money is already revenue, and on the 5th of January, I have a right to actually book the remaining $250. But at that point in time, I either have to have a plane ready for you and you do not show up, or you show up and I actually deliver the service and fly you back to Bucharest. With respect to revenue recognition, there is one other thing which basically I want to comment, and the fact that there are a lot of transactions out there which are a little bit more complicated than the ones that were on the market when the standard was written. So for instance, we have, combined transactions, which are called bundle sales. So for instance, where I'm selling goods together with service. So I'm selling goods plus services. So let's take an example where we buy a car. And I'm actually paying, according to the contract, $30,000 to buy the car and 3 years free servicing. The idea is that in here, the selling company will actually have to recognize two types of services, one from the sale of goods and the other one from the providing of services. And therefore, this type of transaction has to be split in sale of goods. And actually, at the moment when they deliver the car to me, I step in and I drive out of the showroom. This is when they actually book the sale. Meaning when car is delivered. And they are actually providing a service. For the next 3 years, if something goes off is wrong with my car, I will come in and I have a right to get it repaired, fixed, serviced if you want, free of charge. This service cannot be recognized at the moment they are actually giving me the car, which let's say it's now. They have to recognize it over time, meaning over the next 3 years. If it's recognized over the next 3 years, over the next 3 years, I have to show it now at what is called present value. And we are coming back to the valuation of revenue. Every time, basically, I will have a receivable or a payable in more than 12 months from the accounting period, it should be presented in the financial statements at what is called present value, meaning take into the account the time effect of money. What do I mean by that? Let's put some numbers into it. So 30,000 was the value of the car, and that actually represents 27,000 is the selling car, the price for the car, and 3,000 is the value of a 3-year servicing pack. Value of 3 years servicing pack. So the company is allowed to recognize as revenue from selling cars 27,000 at the date the car is actually delivered. So, sale of goods, they will be showing 27,000. With the market value of the servicing for 3 years, that would be actually valued at present value. So the 3,000 should be reflected at present value. So assuming the cost of capital, it's, let's say, 10%. What I mean is that from now, which is the point of sale, until 3 years, year 1, year 2, year 3, okay, over this period, basically, I just have a value of 3,000. So what I have to reflect now is the 3,000 at their present value now means I just have to multiply 1 plus the rate to the power of n, where R is the rate, my cost of capital, 10% in my example, and n is the number of years or periods, which in my example is 3 years. Okay, so the 3,000 will actually be reflected to the power of n. It's going to be 3,000 times 1.1 to the power of 3, and that is actually going to be a value of $2,254 now. Okay, in order for this to actually reach 3,000 in 3 year time, I will have to book what is called a finance cost for year 1, year 2, and year 3, so that the liability, or to discharge my liability at the end of 3 years, to actually reach 3,000. What is that going to mean? It's meaning that over year 1, I will actually have a finance cost of 10%, which is 200, let's say, a little bit rounded up, $225. At the end of year 2, I will have 2,254 plus 225 times 10% again, a finance cost of 247, let's say 248, a little bit rounding up, and so forth and so on, so that at the end of year 3 I will actually reach the 3,000. This technique is actually called in different ways in different standards. So IAS 37, which I will cover, which deals with provisions, will call it unwind the discount. IAS 17 leases will call it lease implicit, rate implicit in the lease. financial instruments will call it amortized cost. The idea is, or the good news for you in the exam is that as long as you do know this technique, which is going to be applied in different scenarios, you will earn you marks, even if you call it in a different way under different standards. And with respect to revenue recognition, there is only one thing that I want to actually draw the attention to. If you are an agent, let's say you are a travel agent, you're having an agency online, and basically you just booked a holiday for accommodation in a very nice and sunshine island, I don't know, take your pick, like for instance Hawaii, for a customer of yours for $100. You have to pay the hotel in Hawaii $900 for this accommodation, and therefore only the difference is your revenue. So the revenue that can be booked by the agent is $100. You are basically not allowed to show revenues in your income statement of $1,000 and costs of $900, which in effect you will still show a profit of $800. This is not allowed. The agents should recognize their revenue coming from their main activity, and your main activity is to actually book holidays for your customers, and your revenue to which you are entitled is just $100.